Hey everybody, how are you? How are you doing? I hope you had a fantastic week or are having a fantastic week. In this video, what we're going to be looking at is multiple time frame analysis. What is multiple time frame analysis? Why use multiple time frame analysis? What to look for in each time frame, because each time frame has a different role it plays in your analysis. And lastly, we're going to be looking at the importance of multiple time frame analysis. So if that sounds interesting to you, please stick with us until the end and consider subscribing so that you won't miss out on future content like this. So without further ado, we're going to dive into analyzing DXY, as I can't think of a better way to talk about multiple time frame analysis without actually analyzing while doing it practically, right? So we're going to start off with the monthly, which is the biggest time frame of them all. So in the monthly, what do you look for? In the monthly, what you look for is the trend, like what's the market really doing right now, right? So for instance, right here, this is from the DXY. You look at the monthly, you see that the trend it's an uptrend because we had lows, prices created highs, which were higher than the previous highs. So these were higher highs, and then created higher lows in comparison to these lows here, and then created an even higher high. So that means this is an uptrend. So prices have a high possibility of continuing with an uptrend rather than a downtrend, because this long term is an uptrend, right? Okay, cool. So now we already got that out the way. We understand that from the monthly perspective, the big boys are saying that prices are in an uptrend, right? Okay. So you put in the structures which you believe will be of help to you, or you mark out the places where you believe are most sensitive, right? So for instance, support, resistances. As you are price action traders, you understand that these are the areas that we look at, the market structures. And since it's an uptrend, you also need to mark out a place where you believe that if prices hit there, they have a high possibility of reversing. Now, in an uptrend, the only places prices can reverse from is a resistance. So based off this market structure that we have here, the most likely place where prices will find a solid resistance to resist from or to bounce off from is obviously somewhere here, right? Because if you look at it from a bigger picture, you can actually see this is kind of like a bold pattern. So for those that don't know a bold pattern, it's a pattern that looks like this. So you have a top here, and then down here you have some kind of a bow, right? So once prices start climbing the other side, most likely they're going to end up at the same height that they did at the beginning of the bow, right? But that's not what we're talking about. We're talking about the monthly. We're just mapping out what the bigger picture is saying. So the bigger picture is saying prices are in an uptrend. Then cool. In the monthly perspective, you're done. You come down to the weekly. On the weekly, here is where you want to make sure that the zones that you drew are at pinpoint accuracy, right? So you want to make sure you're covering the wicks, because the wicks actually measure the most resistive part or the most sensitive part of the trend, right? So you can cover it something like that. Up here. Okay, that's very far away. It's not going to be of use anyhow here. So on the weekly, what you map out is making sure that the zones that you roughly placed on the monthly are at pinpoint accuracy, all right? And then once you come down to the daily, which I believe is one of the most important time frames, the daily, here you actually look for the structure, like the trend. How is the trend going? Now, from the daily perspective, you want to always be going with the trend. You can't go against the trend from the daily perspective. So you can't. So you never want to go against the daily time frame, trend, right? So from the daily time frame, if you're looking for buying opportunities, you want to make sure that the daily is in a buying trend, like it's in a bullish trend. If you want to sell, you want to make sure that the daily is in a downtrend, right? So cool. The daily, as I just said, it's supposed to indicate the trend. So here you can see that the trend is actually bearish, as prices are creating lower lows and lower highs, all that, until prices came down here and they started ranging. So for instance, for me, I understood, like, from the monthly perspective, prices are looking to go bullish long term, right? Bullish long term. So let's take it back from the monthly. I understand that prices are looking to go bullish long term. From the weekly, we see prices are on a support area, and last week they closed with a doji. What happens on a support? Prices bounce from there. Okay, now from the daily, I see prices ranging a bit here. So basically, that is all of these are indications that prices have a high chance of reversing and continuing that bullish trend. So my bias here will be obviously looking for bullish opportunities. So now I go to the lower time frame, such as the 4 hour, where in the 4 hours, what you want to look for are the minor structures and the trends. Minor structure, trends, and confirmation candlesticks. The 4 hour has 3 things. You want to look at the trend, you want to look at the minor structures, and you want to look at the confirmation candlesticks. So for instance, here we notice that this is still the monthly structure where prices are still ranging from, so they can't break below here. Lack of that much momentum. Now our bias is that we anticipate to see prices keep on pushing higher, right? So what we should be looking for here is prices break this structure. As I remember, I told you in the 4 hour, you're looking for minor structures. So it's in the 4 hour, for us to be bullish or for us to take a bullish trade, we want to see a break of this structure, meaning the structure is broken, a retest on the structure. And then once the prices retest here, we want to see a confirmation indicating that prices will go higher right here on the 4 hours, right? So remember again, what I told you, on the 4 hours, you're looking for the structure, minor structures. So for instance, like this one, you want to look for the minor trend and the confirmation, right? So here, the structure, you want it to be broken. You want the trend to be that way. And then at the retest, you want to get that confirmation for prices to confirm that it's going in a certain direction. That's what you want to do on the 4 hours. And then you go to the 1 hour. The 1 hour is obviously for those that have been in the Simple Trading Academy for a while. You understand that 1 hours are mostly used for entries. So here we're going to be looking for entries, obviously, right? So after the confirmation that we get on the 4 hour here, then we're going to be looking for entries using the 1 hour. I like to use the 1 hour because it's somewhat strong. After you get confirmations from all the higher time frames, the 1 hour will most likely give you the least amount of pips you can risk for confirmation candlesticks that's still very valid, right? So you can get anywhere from 10 to 30 pips risking that. But at the end of the day, it's not the number of pips that you need to be worried about, it's your percentage risk, right? Because it never really matters the number of pips, it's all about percents. All right, so as I just showed you, you've seen how we've broken down DXY from the monthly all the way to the 1 hour, right? Now, you've seen that, for instance, imagine a person was only trading off the daily. A person like this can look at the structure and say, oh, this structure is very bearish. The trend is very bearish. Prices have a high possibility of continuing in a downtrend because he only sees this, right? He only sees this. He doesn't know what's going on with the weekly, monthly. So the only picture in mind is this: prices are in a downtrend, without understanding that on the higher time frames, such as the monthly and the weekly, structures are about to change. As on the weekly, we just saw that prices last week closed with a doji on a support structure. This is a great indication of prices reversing and going in the opposite direction. But the person in the daily time frame, only watching one time frame, won't notice that, right? So he can take a sell trade and end up having a loss because of not being aware of the other time frames. So some of the advantages of, or some of the importances of using multiple time frame analysis rather than a single time frame are that it will boost your confidence first and foremost. Like for instance, if imagine looking at a trade all the way from the monthly perspective, it's bullish, weekly bullish, daily bullish, 4 hour bullish, and then 1 hour, once you get an entry, imagine that type of trade and just taking a trade based off the 1 hour without being aware of all the other timeframes. Which one do you think you'll be more confident to take a trade in? It's obviously the first, right? Because you're actually backed up by other timeframes. So you're confident that all these timeframes indicate one thing. So it's very likely that this trade will perform this way, right? So it generally boosts your confidence because you're actually aware of what's going on the other timeframes. And the other advantage or importance is that you get better trades. So it's very easy for you to get better trades because you incorporate all the other timeframes. As we just seen here on the daily, a person using only this one time frame, it's easier for this person to take a sell here without understanding that prices have a very high possibility of reversing. So without that other time frames, you may easily get into wrong trades like this one right here, and which will actually cost you in the long run, you know. So using multiple time frames gives you that bigger picture, bigger view, and it gives you better trades in the long run. And with better trades, the last importance is best results, because we're all in this thing just to make, you know, a living, trying to become better by getting better trades, better results. So incorporating different time frames in your analysis will actually give you better results in the long run. So that's all I've prepared today based off the multiple time frame analysis. If you have any questions, drop them in the comments. I'll be sure to answer them. And if this video has been of help to you, please give us a like, consider subscribing, and share it with a friend that you believe it will be of value to them. Till next time, take it easy out there. Peace.